Index funds, mutual funds, hedge funds, or ETFs. You've probably heard about them before. We'll start with what a fund actually is, then cover the different types, how they're managed, the risks involved, the fees you might pay, the strategies they use, and most importantly, who they're really meant for. What is a Fund 045? Before diving into each type, let's first understand what a fund actually is. Imagine you and your friends are organizing a birthday party. Instead of one person paying for everything, each of you chips in some money. With that pooled budget, you can get food, drinks, decorations, a cake, even music. No single person has to cover everything, and everyone enjoys the full experience without the stress. That's how a fund works. A group of people pool their money together, and that money is invested in assets like stocks, real estate, or bonds. Instead of managing each investment yourself, the fund does it for you, and you get to share in the overall results. Index Funds 138. Now that you know what a fund is, let's explore the different types, starting with index funds, which are probably the most talked about on social media. You've likely heard influencers say things like, "Just throw your money into an index fund and forget about it." But what does that actually mean? An index fund is a type of fund that doesn't try to pick winning stocks. Instead, it simply copies a list or index of companies. Think of an index like a scoreboard or sample group. For example, the S&P 500 is an index that tracks 500 of the biggest companies in the US. The larger a company is, the more weight it has in the index. If the S&P 500 goes up, it usually means the overall market is doing well. There are many types of indexes. The Nasdaq tracks tech giants like Apple, Microsoft, and Amazon. The Dow Jones Industrial Average tracks 30 large companies across industries like Coca-Cola and Boeing. Others track small companies, international markets, or even specific sectors like energy or healthcare. Index funds don't pick stocks, they just follow the index. This passive approach keeps fees very low, typically between 0.02% and 0.20% annually. That means if you invest $1,000, you might pay just 20 cents to $2 per year. Well-known companies that manage index funds include Vanguard, BlackRock, iShares, and Fidelity. Because index funds spread your money across hundreds of companies, they're considered relatively low risk, at least compared to individual stocks. But here's something important. Unlike stocks or ETFs, index funds are only priced once per day, after the market closes. That price is called the net asset value, NAV. So, if you place an order at 11 a.m., it'll be processed at the NAV after the market closes, typically at 4 p.m. This system is simple and consistent, but it means you don't have real-time control over the price you buy or sell at. For long-term investors, that's usually not a big deal, but it's good to know. Mutual funds 557. So, why are index funds so popular? Simple, they're low cost, low effort, and historically perform well over the long term. Even Warren Buffett recommends them for most people because it's very hard to consistently beat the market. Now, let's talk about mutual funds. At first glance, they seem similar to index funds. They also pool money from many investors and spread it across different assets. But the big difference is how they're managed. Mutual funds are usually actively managed. That means a professional fund manager, or a team, actively chooses which stocks or bonds to buy and sell, trying to outperform the market. Sounds good in theory, right? But active management usually comes with higher fees, typically between 0.5% and 1.5%, sometimes even more. And studies show that most actively managed funds don't consistently beat the market. Still, some investors prefer mutual funds for specific exposure, like certain industries or countries, or because they trust a particular manager's strategy. Big providers include Vanguard, Fidelity, and JP Morgan. And just like index funds, mutual funds only trade at the end of the day, based on the NAV. Hedge Funds 801. Next up, hedge funds, a completely different kind of investment. The term hedge comes from the idea of reducing risk, but in reality, hedge funds often chase higher returns using aggressive strategies. So what exactly is a hedge fund? It's a private investment fund that pools money from wealthy individuals or institutions and invests in all kinds of assets, stocks, bonds, real estate, currencies, derivatives, and more. Unlike index or mutual funds, hedge funds often use short-selling leverage, borrowing money to invest more complex derivatives. They're actively managed, and fund managers have lots of freedom to take big risks. This means they can make huge profits, or suffer huge losses. That's why hedge funds are usually only open to accredited investors, people with high incomes or net worth. Their fees are also much higher, following the 2 and 20 inches model. 2% annual management fee, 20% of any profits. So, to make it worthwhile, hedge funds aim for much higher returns, but that comes with much higher volatility and risk. ETFs 937. Finally, let's talk about ETFs, exchange-traded funds. ETFs are like a hybrid between index funds and individual stocks. Like a stock, they can be bought and sold throughout the day on stock exchanges. Like an index fund, they offer diversification by pooling money into a variety of assets. Because they're passively managed in most cases, ETFs tend to have low fees, usually between 0.03% and 0.75%, depending on the type and management. Many ETFs track indexes. For example, you can buy an ETF that mirrors the S&P 500.